The Fed decided to stick to its guns, keeping interest rates low, and so are we. We're going to stick to our guns. We've been expecting this to happen. The market has been expecting this to happen for the Fed to remain relatively dovish, not to start tapering here. That nobody was really thinking that. But we only saw one of the two reactions we had actually been expecting, and we're happy with that. We are happy to see that interest rates ticked up. This is a rational move. Now, in typical times, this wouldn't happen. You wouldn't see the Fed keep interest rates low and then interest rates go up, right? That doesn't make sense. That hasn't been happening this whole time, but we're now starting to see inklings that the market is acting in a rational way to reality. It has not been acting in a rational way to reality for a very long time. This week, for example, and the previous inflation reading, we had seen the market rally on inflation data. The past several months, we had seen the market sell off on inflation data. Over here on this channel, we believe inflation is good for stocks. There's a lot of people who share that consensus as well, but we've been believing it for a very long time and stuck to our guns as the market sold off on some inflation data. We never believed that was the correct response. It was a silly response in our view. And we are sticking to that position. So we expect inflation to occur. Chairman Powell did not do anything to exacerbate our inflation beliefs, though. If anything, he kind of, made me humble and hit me with a little bit of reality with some interesting data. The fact that 1/3 of all the CPI increase was used car sales, and that does seem like a temporary indicator. However, I do question that. If I think he's missing some information that has come out of the mouth of Mary Barra, the CEO of GM, who said that it's unlikely that production levels are going to return to pre-pandemic levels. And this likely has something to do with the competition between car manufacturers and Uber. It seems like they are happier with higher prices. They want prices to go up, offer a more premium product, keep margins high, most likely. So that is, a sector trend we really have to see. Again, giving some credit to Powell, he says a lot of it has to do with sector by sector. We have to see what happens with that. But, 1/3 of the index is used car sales, which probably doesn't make a whole lot of sense and possibly could revert the other way. We've been seeing what's happening with lumber and copper. That's probably going to continue now that rates are ticking up. Hopefully that sustains itself. We will see what happens. It seems like housing is going to slow down, and that's probably going to decrease the demand for lumber, at least for the foreseeable near to medium term. But we are seeing inflation, what seems to be slowly, and to a less extent than lumber and copper, across the economy. I'm sure anecdotally you've seen it. It's certainly there in meat prices. It's not just these three categories. It's there. Restaurants are feeling it. Every CEO is talking about it. It's not the stock market people who just say it's lumber, copper, and used car sales. That's just not the truth. You actually have to talk to people who run businesses rather than look at charts all day, and they will tell you that there is actually inflation. And if you are going out and doing things, you are seeing it out there in the real world, and that's where it takes effect. So inflation seems to be occurring, and we are going to remain in our inflation playbook. Now, this is important because it's not typical. We have been in a not typical environment for a very long time, and we are going to continue remaining in a non-typical environment. For example, typically, and in the past couple months before people started reacting to reality in a real way to inflation, when they were selling stocks on inflation, bond yields ticked up and stocks went down. And that is a typical response. That's what happens in normal environments, low inflationary, low stimulus, normal environments. That should be the case because bond yields present long-term cash flows. And when those give better cash flows, they compete with stock cash flows in the market for investors. But now, in an inflationary environment, they both kind of have to go the same way, bond yields have to tick up and stocks have to rise because there's this weird multiplier on everything, which is inflation. It's literally a multiplier on everything. So nominal interest rates are likely to rise, meaning the actual number that you are paying to borrow a dollar is going to go up, but the real rate, so the nominal rate minus the inflation rate, probably is not going to change that much. And that means that stocks can continue to rise because these companies are still going to borrow money, and yeah, they'll be paying money back, more nominal dollars back, but the value of the dollars that they're going to have to pay back is going to be less. They're going to be increasing prices in the meantime when they get the cash. So stocks can also rise. It's not a normal environment. This is a blue ocean kind of, Chairman Powell said it best, like, we're gonna see what happens. Nobody really has a total blueprint. I can be wrong. That's totally possible. So we'll see what happens. We're gonna develop things and see how things go. But right now, I believe the safest portfolio has a lot of inflationary stocks. And we like our case for energy. We believe energy is safe in an inflationary environment. The price of energy is very high. And the full energy demand hasn't even returned yet. The United States is not fully open. Europe is definitely not fully open. UK is going back into lockdown. Yeah, energy's rising. India is still very much in lockdown, not very much open. Third largest energy consumer in the world. So it seems to me like the forces to propel energy higher are still intact, and the price of energy is very high, making these companies very profitable, and they're still very cheap even at the current price, and the price should continue to go up. So energy is definitely there. Commodities elsewhere, I've made the case for Mosaic. You can go find that on Twitter. That is a fertilizer company. Farms, I've been very bullish on farms for a very long time. Those of you who were watching my stuff last summer, remember when I was in that phase of comparing what could or would happen to the 1920s and 30s Weimar Republic. And farms did very well in that environment and will do well in any inflationary environment, I believe. So farm and farm-related products, good place to park your wealth, should maintain and or grow in that possible trend. So inflation stocks, inflation areas of the market. In addition, we are, love my growth. I really am a growth bug at heart. But I'm not, when I say growth, I don't talk about Apple, Facebook, and Amazon. I do not, let me repeat this. Do not use Facebook, Apple, and Amazon in the same category as growth. I think those companies are close to done growing. Yes, they're going to keep growing. It's possible. Like GM, going to keep growing. But is GM a growth company? No. They are at their final stage. That's not the growth I like to buy. I like to buy new emerging technologies and very cheap tech stocks that have the potential to 5 or 10x. That, in my opinion, is a growth stock. Not Apple, not Facebook, not Amazon. They are big. They can't really grow a whole lot, if you ask me. Sure, they might continue to get more crowded in terms of stock buying and ownership, but in terms of actual growth, what, is Amazon going to capture another 89% of the U.S. population? No, it's not. Can't do that. Literally, it cannot do that. Facebook, sure, maybe they can provide internet modems to all of Africa and grow into the African market. Whatever. You see what I'm saying? You see how I'm feeling? That's the portfolio. Growth stocks, 5 to 10x, and inflation stocks being the main core. So until next time, peace out.